We've been spoiled, Scott. Yes, we'd love to see a broad rally all the time. Right now, though, you're getting an opportunity to come in on some names that historically you may not have been able to come in at. What do you see? A target down 13%, right? You talked about earnings in the earnings season. And yes, Scott, looking in the rear view mirror, that's what we're doing. We are getting forward guidance, though. People are being conservative. Management teams are being conservative. If I'm a management team reporting in the next couple of days, I'm using the coronavirus to my benefit to broaden that range to give me a little breathing room. The smart ones are doing that right now.
So I don't understand. So none of this matters to you?
It's not that it doesn't. It's not that it doesn't matter. You literally just said. This is your words.
Yes, the foundation is showing signs of cracks, for sure.
No, you didn't say
cracking.
That. You said is cracking.
You got a third of the S&P in correction or worse. What is that?
Stocks went up 50%.
You got 40% of the Nasdaq 100.
Stocks went up 50% and pulled back 4%. The foundation is undoubtedly cracking. Sorry, it's early. No. It's early.
It's way too early. It's way too early. And you'd rather see something like this early in the year and like a coronavirus. You don't want to see that in the back half of the year. This is when actually you want to see some of this shifting so that you have an opportunity to get in. The back half of the year is when you get scared.
You had no reason at all to be negative until recently. We're right around record highs. Now
it's not negative,
we're talking about stocks that are a lot of big names that are down in some cases 20% or more.
Off a 52-week high that has never been seen before. I mean, put it in perspective, Scott.
The reasoning, I think what we're really talking about is the reasoning why we've pulled back from 33. What are the conditions? It's not about earnings. It's not about companies that are coming in and not giving strong guidance or missing their numbers. It is about a 3-month to a 10-year inverting. Why is it inverting? It's inverting because the perception was that we needed economic growth to spread beyond the United States. And the risk now is that you're not going to get the growth outside of the United States. So you're seeing the 10-year has fallen 45 basis points. These are just conditions that are impeding further appreciation for the equities market. I think it's warranted.
The inverted curve doesn't matter at all.
No. I didn't say it doesn't matter.
Yeah, you were dismissive of it.
Too soon.
No, you were completely dismissive of the curve.
You also said repo, which is right, though.
But we know why it's inverting.
We do?
First of all, the 10...
You said it had nothing to do with the economy.
We know exactly what's going on. We know exactly. It's not an economic signal when the Fed is telling you that they are operating at least through April in the overnight lending market. That literally pushes up one part of the curve and pushes down the other. We know they're doing it. They said they're doing it.
Josh, they're only buying 14-day paper. They're not affecting.
But the supply in the 3-month is slightly increased.
Listen, the reasoning that the 10
and 2s have not inverted, Joe.
No.
The 10s and 2s are close to inverting. I'm not going to argue what has, what hasn't. I'm just telling you they're not buying 3-month paper. They're buying 2-week paper. And the 10-year has pulled back 45 basis points because the market is concerned about falling oil prices. It's concerned about the coronavirus. Whether it's warranted or not, I don't know the answer to that. I'll tell you the credit markets are fine.
Well, of course
high yield,
it's warranted as it relates
grade,
to the coronavirus. I mean, because no one knows what's going to happen.
And that's a flight
Anybody
to
who
safety.
suggests that they do
and in that
doesn't know what the heck they're talking about.
And in that flight to safety, you're seeing that there is an impact that is affecting or not allowing the strong visibility that we're getting from earnings results to allow the S&P to move higher. That's what I see it as. I've said the month of February is challenging because you move away from earnings and you have a capture of significant headlines that are going to look troubling in the long term. I don't think they are. I think we're fine over a 6-month period.